Okay, this is the second video for the master budget. Make sure you do these in order because they interconnect and relate to one another. So you don't want to get them out of order that they feed back to the previous schedule. So you want to take them one at a time just as I'm rolling it out. So the directions, we're going to do two tabs. We're going to do this SG&A budget and this cash receipts budget in this recording. We'll start with the SG&A budget. And we're going to use the same equations, the same cost equations you developed when you did the regression analysis and all those graphs a while back. So we're going to reference back. I'm going to show you how that's done. So starting with S, here's your 2019 data. So this ties back to what you just built over here for the roasting, right? For 2019, this came from your previous assignment. Okay, and these are the regression results that you had run for the roasting business. Those were from those graphs that you did. So they're exactly the same. We're making the assumption that the costs haven't changed in terms of their structure. Okay, notice that I multiplied here times 12. So I took the fixed cost that you had generated, which were a monthly fixed cost, and I multiplied by 12 to get an annual amount because we're building an annual budget. So to roll this out, so now I hope you really value the time you spent creating that information, those graphs and the equations you got off. Because now all you got to do is change the quantity. So we'll bump it by 105, same as before. So for the matching principle, we're consistent. And then we'll just use those costs and roll it out at this new volume. So it's units times variable cost per unit plus the fixed. So what a great tool that you now have these equations. So when you go to build the budget, it's really easy to do. Let's get rid of those dollar signs. They make it look messy. All right, the depreciation, we can't use the prior one, which this was right off your graphs as well. The depreciation changes every year based on whatever's in the schedule. So we've got to go to the depreciation schedule cell C104. I've got that dollar amount over there for you. We'll look at it. So C104 is right there. That's the roasting 2020 roasting depreciation budget for SG&A right there. Okay. All right. Same thing with the cafe. These were the weighted average number of units that came right off your sales budget here, right? Same tie-in. These were from the cost equations you generated a few weeks ago. So all you got to do is edit quantity times 105. You can roll that down. So that matches with what you got over here, right? There it is, same right there. And just run it out. So it's quantities times variable plus the fixed, which is annualized. And we'll copy that down. Fix those dollar signs. And let's go get the depreciation. So this is for the cafe. You'll have two pieces to pick up. One for the cafe's SG&A and one for the kitchen, because the kitchen, remember, is buried in here. So if we go to the schedule, D93 right there. That's the cafe's SG&A for the year 2020. And then add to that the kitchen right there. Kitchen budget SG&A right there. You got it. All right. So that is, yep, C13 and D93. We're good to go. All right, this is just for pulling together the two tables. So you've got roasting up here. Let's go get it. Salaries, payroll, plus the cafe payroll. So pull together like items so we can get it down to one budget for the entire company. Okay, and that depreciation is okay because you're adding the two scheduled amounts that you calculated right up here. So we're good to go on that. That's perfect, just like that. All right, so that's done. The next one is the cash receipts budget. So what you're going to be focusing on here is any monies that have come in from customers or from the sale of stock or from any other means that have added to the company's cash amounts. So let's go back to directions. There's a few assumptions here. We're going to make an attempt to maintain 30 days of receivables, so about 1 month. Well, it's a little higher than that last year, but we'd like to set that as a goal for improvement. We're going to assume the same rental income as previously. We're not going to increase our rental income amounts or monthly rates. We're not going to assume any additional unearned revenue for the year. So no change in that account. And we're not going to assume any additional stock sales for the year. Trying to keep it as simple as we can and just focus on the main moving parts. Okay, so going over here, we've got first the money that came from those customers that are on AR. So this is tricky because you've got to look at what you've got in previous balance. And now we'll use this balance sheet. We got to go back here and see what we have. So remember, they pay every 30 days. So this is going to get paid in January of 2020, right? Because that whatever you see in the account is the previous 30 days of accounts receivable. So that's going to get paid. You got to pick that up. And then the sales that go to the wholesalers are right there. So you're going to pick up, you're going to collect 11 out of 12 months of that. Okay, so that's one way to do it. You can grab the whole thing and subtract 1/12 as well, which is the formula that I have set out for you to do. I'm hoping that makes more sense. So you're going to basically back out what's still in accounts receivable at the end of 2020 because you haven't collected that yet. So let's give that a go. Go get the balance sheet, previous balance. We'll go get the sales. That's for the wholesalers, and then we'll back out the same cell times 1/12. So meaning we're pulling back what's in accounts receivable because it hasn't been paid yet. I'm trying to do cash receipts. Here we go. Go get receivables from last year. So we need that. Then let's add in any sales that were made to those customers that are wholesale, because these are the customers that are on account. And then what we're going to do is subtract from that same cell times, put it in parentheses, 1/12, so 1 month of that amount. Okay, so let's show that to you again. Let me hit enter and then we can look at that. Okay, that is correct. Let's double check that. So it is the beginning balance sheet D6 plus sales, cost of goods sold budget H8 minus the same cell H8 times 1/12 times 1/112 times 1/12. Okay. What you're doing there on that last piece is you didn't collect all of those sales. You collected 11 months of them. The 12th month is still in accounts receivable because they're on a 1 month lag. Okay, so that's why you're backing that out. And that's going to be the amount that's on the balance sheet for accounts receivable. It's 1/12 of that sales amount. We'll get to that. That's next week. All right, the collections in the cafe are over on the sales in H9. So let's go get that. In the sales H9, that's the cafe amount right there. And then the other one was in cell H10, that's this one. Okay, so we got those three pieces. We got the wholesaler amount, backing out 1 month for accounts receivable. These are cash sales and these are cash sales. This is actually intercompany, but we're gonna treat it like cash and then we'll have the other side of it too, the payment. This is the receipt side. All right, then the collections on the cafe, those are all 100% cash sales. So we're just going to go over and grab that. It's in H40. Okay, sales right there, H40. Okay, and then like I said, the rental income is going to be the same. So let's just grab that. And I said nothing for unearned and no sales stock. So you can put zeros in there and that's it. That's perfect. We're ready to roll. Okay, so save your file there, just make sure, and then you can start the next video.